All right, everyone. Well, hey, we are back from our short break for our investor note deal panel here with two of the sharpest minds in the note industry and two guys I am proud to call very close friends, brothers from other mothers. I say when I was traveling and teaching workshops all across the country, these guys always were very would take time out of their busy and hectic schedules to come out and spend a day or two with at our workshops and really just be there to give and help educate people out, new investors. I've bought and sold assets with both these guys in a variety of different trades. And as I made the reference, we do trade, as Val would like to say years ago. But what I'd like for you to do is, why don't we talk a little bit, have you guys introduce you, because we got so many new people on Note Camp here, people listening to this, and then people watching the replays, and then listening to all the podcasts when it comes out in a couple months. So let's start first. Val, you were on here first. So Val, why don't you share a little bit about your background, how you got into the note business, and kind of what you're doing these days?
All right, so my name is Val Sotir. I run Watermark Capital Funding and the Watermark Exchange. After college, I started on Wall Street as a stockbroker for about 10 years. So all throughout the 90s, I spent selling stocks, trading stocks. And then in 2000, roughly 2001, we got into, most of the whole Wall Street got into the mortgage business. So I ran a subprime company for the next 9 years. And in 2008, as everybody knows, we had the big collapse, and we kind of had to restructure and look for different ways of making money, right? And I got into the note space. I used to securitize mortgages and sell them in bulk. And somebody brought up to me the fact that we can buy and sell one note at a time, and that's a different story. And I got into the note space, and I've been doing that ever since. That's in a nutshell. I don't want to make a long story. We can answer questions later, but in a nutshell, that's my story for the past 29 years.
There you go, good stuff. Joel, let's talk a little about you and how you got into the note business.
Well, I kind of backed into it. I had always been in the collection, the collection of debt, and I had actually went and started a business, family business. I was looking to kind of make a transition, back in 2009, and a friend of mine had a company that did all of the outreach for Citi and PMI and Genworth and Saxon Mortgage, Auckland. And so he hired me to work, going back and looking at quality control, making sure that we're in compliance with SLAs, SOWs, statements of work. And that during those times, there's a lot of governmental reporting. At one point in time, we probably had 20 to 30,000 files coming in at a month. But one day, someone came to us and asked if we can do outreach on a portfolio of notes. So I asked them to explain, okay, exactly, tell me what this is. It was, just an offshoot of what we were already doing. So we started doing that. And we started doing the outreach. I was actually running a call center where we had probably about 270, 280 people in Irvine, California. And the notes, all of a sudden, it was, a big difference, because notes, you weren't concerned with governmental reporting. You weren't concerned with anything other than how do you turn that note back into cash. And so, pretty much started going on the road with yourself and a couple other people talking about the loss mitigation aspect, which was kind of a piece of the pie that people didn't have a good grasp around. And, so then pretty much been in and about doing that over the last, oh my gosh, since 2009. So, before I had gray hair.
It helps if I unmute myself, right?
Yeah, I thought it was me. I'm looking, yeah.
So sorry, go ahead.
So just been doing that since you're focusing on 2009, and over the years, you have relationships and friendships, and some, there's an ebb and flow with different things, and you learn different things. And it's about a cumulative amount of learning that you can now bring back to it.
Mm-hmm. Yeah, I think we originally met. You reached out to me because you one of your borrowers got one of my mail pieces when I did a direct mail piece back before CFB PB, wanting to get a loan mod approved that I was offering up, even though I didn't own the loan yet. It was a marketing piece. Don't do that now. But we've known each other since he came and spoke, and we've done a lot of business together. Same thing, Value, and I've bought assets with it. We helped him move assets as well through marketing and stuff like that. Let's kick this back to Val a little bit here. So we got a lot of new people out here looking to get into note investing. What would you say is one or two pointers that you would tell somebody who's brand new looking to buy their first couple of notes, non-performing notes or performing notes?
Okay, so first and foremost, education is very important. Like in every business, you're gonna start in a new business. You want to educate yourself. You want to make sure you know as much as you can about purchasing a note. And it's almost like purchasing real estate, bricks, as we call it in the business. It's bricks and paper. But once you do that, once you've accomplished, getting as much knowledge as possible, then you have to purchase a note. And I do sound like a broken record because I think I said this to you, Scott, and to your students a million times, but it's so important that we have to repeat it and repeat it and repeat it. I say that at one point, at a certain point, you got to start buying, and you have to buy one note or two notes or three notes. If any seller, I'm a seller of notes, but if anybody tells you got to buy bulk on your first trade, do not do that. Buy a note. The experience that you get from buying that note is priceless, because from buying two notes, you may have 5 experiences, right? You may think you're buying the note and it's going to be an easy foreclosure, but then you find out that you can reperform the note. Or then you can find out that the guy doesn't want to reperform and he can do a quick deal on you. So that there are so many exit strategies that you would experience after purchasing that note. Look, I have a good example. When I was a trader, a stock trader, before you start using your money, they give you, you go on and you write on a piece of paper at 2:25 p.m. and 15 seconds, I bought IBM at $43, right? And then, it's make believe. And then 2 minutes later, I sold IBM at X amount of money. 98% of us trainees made money almost 100%. Once money got involved, once we actually started trading with money, there was only 12% of us that broke even. So the point is that experience. I learned more from losing some money or breaking even than I've learned, just studying books and what have you. So the point is, make sure you secure your principal. Don't just buy loans because Val told you to buy loans. Make sure your principal is secured. You check your BPO, you check your title. You want to make sure that you buy at the right point. But do not, and this is my last point on this, do not calculate your profits ahead of time. So in other words, a lot of newbies get into a trade thinking, I need to make 30%. Well, that's great, but that's an assumption. Once you make that first phone call, once you purchase that note and you make the first phone call, a lot of things will open up. Good things, bad things, things in the middle. But that experience is priceless. And I can start with that for now.
Joel, what would you recommend on top of that?
I think it's a good understanding. Val's absolutely correct. You have to start with one to figure out, and where you start off with, in day one is not where you'll be in 3 months, from the 6 months, a year down the road. The one thing is, I think, is to get a good education, but also at the same time realize that someone's going to make a mistake somewhere along the line. We all do it. Anybody who says they've never made a mistake on any of these is just not being truthful to you. And just learn to figure, okay, how am I gonna, if I make a mistake, how do I recover from that mistake? And just figure out ways in which, take a deep breath and just, okay, life is going to go on and we'll figure this out. Because there's a big upside that you can create out of it. But as Val said, you learn more from losing than you do necessarily from winning. When my wife and I were looking at this house, we probably saw 50 houses before we found this one. But it was just as important to find out what we didn't like than what we did like. So that, guys, is exactly what Val's suggesting.
Just 50 houses you looked at with Donna, that's it?
Yeah, I probably
I don't believe that, Joe. I don't believe that.
43.
Yeah, that's a great thing. Let's talk a little bit about the flexibility needed, though, because we all like, hey, specific strategies. But one of the biggest mistakes I think I see a lot of investors make, they get into it and they're just focused on one strategy when they buy the note. And then when something goes haywire, they freeze and don't know what to do. Look, can we talk a little about that? And Val, I think about when you think about it, I think about those Columbus, Ohio notes you bought about 5-6 years ago, where they were left over from a portfolio that you got flexible with to turn lemons into lemonade.
Right. So I understand that a lot of real estate brokers, right? So in other words, this is a niche. This is the note market. So a lot of people that hold real estate, so let's call it bricks. They can have 20, 25 years experience in the brick market. That's great. The due diligence buying a note, it's almost the same, give or take a little bit, you know, when you buy a note. The only difference is you cannot walk into the house, right? Now, and the brick traders and brokers, they are used to buying and selling, buying, foreclosing. And a lot of times they buy the foreclosure, correct? So now they have to get used to the paper business, which is a lot more profitable than the brick business. In other words, it's not much, you don't need to make investments in it. I bought a lot of notes in Columbus, Ohio at one point, so that's the one you mentioned. I didn't want to buy them. They were part of a portfolio, so I got stuck with them. These are homes right near Ohio State University. These are homes that were worth $30,000, $35,000, $40,000. And every other home on those blocks were burned down. I mean, it looked like a war zone, to be honest with you. But guess what? The rents were $750, $800, $900. So it really doesn't make sense what I just said to a lot of newbies in the business. It didn't make sense to me. The homeowners that lived in those areas couldn't afford to buy a $40,000 house. They needed to put a down payment and they needed to have good credit to buy the house. It makes a lot of sense. First, when you ask for a $50,000 mortgage at a bank, it's tough to get a $50,000 mortgage. It's easier to get a $400,000 mortgage. But they were able to pay $750 a month. And I had a mortgage company. I did mortgages for a living. I never believed that was possible. If anybody had told me the story I just told you, it wouldn't have made sense, but it did. So then I learned, and look, I have to be honest, I was into let's buy and foreclose, let's buy and foreclose. But then you're going to find out, and this is my experience, maybe Joel has a different experience, but my experience is that you will make more money if you keep the homeowners in their home. If they want to reperform, give them a break, because most of that payment coming in is interest only for the first 12 months or 24 months, whatever deal you make with them. If you need to foreclose, you need to foreclose. But there are so many exit strategies that I'm sure, Scott, you've covered throughout the conference. There are so many exit strategies that you need to keep in play. Of course, we all use the foreclosure gorilla. Hey, if you don't behave, if you don't want to cooperate, we'll foreclose on you. But trust me when I say, if you keep the homeowner in the house, look at their emotional equity. It's important. When did they purchase the house? How many kids they have? The kids are what, 12, 13, 14? They bought the house 16 years ago. Well, those kids went to that elementary school in that neighborhood. That's emotional equity. That's so important when you purchase a house. And do the right thing. Be a nice guy. Don't be, excuse my language, I'm sure there's all adults here, but don't be an asshole when you call that homeowner. Try to help them out. And at the end of the day, you will make a lot more money than foreclosing on a home, period.
Love it. Joel?
No, he's right. Look, if you get into this, I've seen some people who've gotten into this over the years, and they're very harsh. It's like, basically you want to hang everybody, and you want to take back every property. Yes, you can do that, but quite frankly, I think, if you're really looking for benefit, you want to talk to people. You want to be able to get them on the phone. You want to be able to work something out. Frankly, you want to be a human being. And a lot of times people have not had anybody on the other line reach out to them and treat them with dignity or respect. And I think that was always our premise when we were calling on all those accounts. It was, How do I have a dialogue with them? You want to control the conversation, but at the same time, you want it to create a win-win for them. Because frankly, at the end of the day, some people, it would disturb them to go to sleep at night if they, if they behaved in a certain manner. And so I think you can accomplish that. And I think you can do good things in a bad situation. I try and I've always said to my son and my daughter, you can have a unpleasant conversation in a pleasant manner. And I think that's kind of what you should strive for. I think it's more complicated now than it had been over the last few years, just because the ability to do outreach and how you do it has kind of transitioned. But when all is said and done, you want to get a hold of the borrower. Unless your goal is to get an REO and you wanted to turn it and flip it, then okay, then you're looking for notes that are vacant. But if you don't, then you really want, that's one of the characteristics that you're going to look for in the purchase is, okay, the borrower is in the property. I mean, that's the first one. And the beneficial reason is because if you have that checks another box and it gives you more options. And as Val said, there's a lot of exit strategies. So why eliminate them if you want one or two if you don't have to? So by having somebody in the property, not being afraid of bankruptcy, things of that nature. But those are things that you will learn over time.
Yeah, that's great stuff. Now, one of the things that you and I, all three of us have talked about, and I remember us having conversations at dinners or with bar tabs that were the price of some mortgage payments before in the past with us in Vegas. But talking about how when everything hit the fan in 2010, we all thought it was like a 3 to 5 year cycle, right? And it was longer than that. What does your spider sense tell you is going to be the effects of kind of what's going on right now? And I'll start first with Joel, and we'll kick it back to Val.
Well, so let's go backwards, and then we can come forward. So when you go backwards, yes, there was a lot of different. There was a lot going on. And there was a bunch of different programs, and a lot of the programs were scheduled to end in 2014, 2015, and then they extended them. You had people who were economic forecasts that were coming out, recession in 16, recession in 17. So at this stage of the game, the market has been ever evolving. Right now we're seeing a correction, but it's a correction that is not, there's nothing that goes along the 2008, 2009 recession and what's taken place back on March 13th. They're not anywhere near the same, so you shouldn't lump them together. In 2009 and 2010, 2011, you had a meltdown of the global economy, and the foundation was really along real estate. What you're having in March of 2020 is nothing related to real estate. So the pricing, and I think there's a sincere disconnect of pricing in the marketplace. The pricing in 2009, 10, 11, well, you can buy Michigan for 17 cents, you can buy Florida for 22 cents, you can buy California for 50 cents. I mean, that's not coming back. And anybody who thinks it's going to happen now, I think you're a little off the mark. What you're seeing now, and I had a conversation today with a friend of mine who's one of the top 3 or 4 non-QM originators in the country. And what's taken place now, March 13th, prior to March 13th, I'll give you a quick story, I apologize, but he was selling loans off of his warehouse line for 104, and then a week later it was 103.5. Then you had March 13th, and people were coming to him and offering him 80 cents. And he said, no, I'm not selling at 80 cents. And these are not originated, non-QM, performing. And so he said, no, look, I'll get them off. I want to get them off my warehouse line, but he set the price at, I think it was like 92. So they eventually came up to 90. He said, no. Then the market started getting better. He went up. He kept going up. They kept chasing the price. In the meantime, as of today, he can sell, and he's securitizing everything that's been on his warehouse lines. He's at par at this point in time. And now he'll end up making money because he kind of sat with it. But at the same time, he had these warehouse lines that the lenders were patient with him because they didn't want to take a bath either. So because they were patient. So my point is people were chasing the pricing. There was a disconnect in the non-QM market. And I think there's still a disconnect in our market. Sellers are thinking X, buyers are thinking Y, and there's a gap. I think it's starting to get better, but March and April, everybody had these illusions of 2009 and 2010, and that's just not the reality of it. And quite frankly, the recovery is not going to be. Recovery from the recession was based upon supply and demand in the real estate market. That's not going to take place here, in my opinion.
So do you think we're going to see an increased number of defaults and foreclosures and things like that?
Of course you're going to. I mean, people are in forbearance plans. You have, whatever it was, 30 million people who have filed for unemployment, and we don't know how many are going to be going back to it. Of course you're going to see that, but you're not going to see it on, pre-recession levels of 09 and 10 and 11 and 12. You're just not going to see that. I think there's going to be certain areas that are going to be hit harder, like everything. But like, for instance, and I'm in California real estate, you haven't really seen a whole lot of movement. If you're buying a loan and you're going to have to foreclose on it. So now you have to factor in that it's going to take me X amount of time longer. So you have to factor that into how you're bidding and things of that nature. I think there's always, there's going to be ebb and flow in markets, but I think you'll see a correction. So maybe you see a 10%, a 20% correction, maybe even a 25% correction on pricing, but you're not going to see a whole lot more than that. You're not going to see those, silly prices that you used to see.
Exactly. Yep. Val, how about yourself?
All right. Where do I start? Look, you guys know me. I'm a very optimistic guy, right? Even in the worst of times, I'm very optimistic. And I'm optimistic now. I have a little chip on my shoulder right now that I have to kind of get out. But I agree with Joel. Let's start with 2008. So what Joel is saying, and I agree with him, there's a stalemate going on right now. The same stalemate that I experienced in 2008. 2009. So the stalemate is the sellers weren't ready to take a loss, and the buyers, and I was one of the buyers, saying, hey, the world just collapsed. We need to buy it X. And the seller said, I'm not ready to take a loss because I don't have it. So there's a stalemate. We were like this. Joel is 100% right. Back then, it was an economic collapse. It was a real estate collapse. So it was exactly what collapsed was exactly the world that we were participating in. Here's the problem we have today. We have a consumer confidence collapse. Of course, the traders are not willing to take a loss because in January of 2020, we had the best economy this country has ever seen. We had the lowest unemployment rate for African Americans, lowest unemployment rate for Latinos, lowest unemployment rate in 75 years for women. This was the most robust economy this country has ever seen. And now this happens. Here's the problem. The problem I have right now, and this is a question, maybe there's something that we all need to discuss and kind of put our heads to it. We have a moratorium of 90 days by these judges, right? So let's take red states. I mean, this is all political. I'm an immigrant, but let's take red states and blue states. The 3 months in the blue states, the 3 months more, the 90 days, it's going to go to 6 months. It's going to go to 9 months. If anybody in our business thinks you're going to be able to foreclose on anyone until December of this year, you're out of your mind. Now, so December comes around, and now we're going to January. Let's say everything goes back, and the economy, the stock market goes back to 30,000. The economy is great. Here's the problem. Those judges that we're going to go in front of are human beings. They're not robots. They're humans like us. And the homeowner is going to go there and say, hey, I've lost my job for 6 months. I wasn't working. I have 3 children. Where do you think, what's going to happen to my family? We will not be able to foreclose for the next year and a half. Let's accept that for a fact. And things will change. And that's the problem. Now, at Watermark, I don't like to foreclose even before. If I had to, I had to. But because I was able to use the foreclosure scenario, the homeowners were willing to work with us because they want to stay in the house. Now, I am in New York City. The whole country became New York City right now because they know that there's nothing you can do to them. Now, 2008 and 2020 are completely different. The problem we have now, and I'm an economist at heart, right? You don't make money by being a professor, but you make money doing trades. The problem we have with this is that, again, going back to the consumer confidence. People are not going to go out and spend money and buy 3 pairs of pants and five shirts anymore. You know why? Because they are scaring us right now that something's going to happen in the fall. The second wave, the third wave. We are all smart people. Everybody's smart to that point. You know, why would you do that unless you want to collapse the economy? So this is my chip. We were doing great. You guys know what my wife does for a living. There hasn't been a death of COVID-19 over the past 3 weeks at a hospital, and she works at a Brooklyn hospital. You know what happened in her neighborhood for the past month and a half? The Hasidic Jewish community had 4 funerals and 3 weddings. You know how many people went to those funerals and weddings? Thousands of people. Nobody is in the hospital dying of COVID-19. That's the problem I have. A lot of people died. Don't get me wrong, it's a virus. I'm not a doctor here, but there was a virus. But to collapse the entire world over this is totally unacceptable, and none of us have anything to do with it. You know, we cannot solve it. But that whole idea, we need to incorporate it into our business. We're not going to be able to foreclose for another year from now. Now I can smile. That was my answer. The consumer confidence, and one last thing, 30 more seconds. 70% of the US economy is based on consumption. 70%, is based on consumption. That consumer confidence is at 17% today. Nobody wants to spend more money than they have to. And I agree with Joe that it's going to take a while for the economy to come around. Joe's 100% right because of that factor. So there you go. I just said what I had to say. I apologize to everyone of my rant, but I have to.
You know, I think you guys both make very valid points on a variety of things, of where things at and confidence levels and buying levels. I mean, I've had these individual talks with both of you guys in the last few weeks, actually. You know, hey, where are you seeing things at? What are you doing? I mean, I think a lot of us are making phone calls, testing the market, but still things are happening. Still, people are still buying houses. People are trying to sell homes, still trying to move. You know, offices are, you know, people are still paying rent on an office when they can. Somebody asked a question, do you think there will be a forgiveness of rents and mortgages or a wipeout of debts with a reset in fact, or maybe even bringing back like the hardest hit funds that we know have been away for a while? Do you foresee something like that happening possibly? Joel?
Anything is possible, and I want to avoid any discussion of politics in any way, shape, or form. So, but those type of programs and everything will be pushed by the politicians or whoever introduces them. And I don't know that there's an impetus to find consensus on those type of things. I believe that each individual state, in my opinion, what this pandemic has shown us is the independence of the state's governors, whether it's the governors of Florida or Georgia or New York, Illinois, California. Those are the ones who are a bit more out there in the national scene. So I think individual states may, that's where I think you'll see some of these potential programs. I know in the state of California that, go back 3 years, Governor Brown put in all these programs in order to save a lot of money. And he actually built up a rainy day fund. Rainy day came, So the state of California is going to be in a position to do certain things. They've done that around homelessness a little bit, and they're also looking at real estate because nobody wants real estate markets to crater. That's not good for anybody. And I don't care, right, left, forget it. If it craters, it reduces the ability for people to live fulfilling lives. To Val's point, the consumption drops dramatically. Your taxes, property taxes and other taxes that are generated in order to feed local businesses and things, those things dry up. So I believe what you're going to see is you'll probably see programs from state versus federal levels. And I believe there is an impetus from the GSEs, Fannie and Freddie, the forbearance plans that they put out, 6-month forbearance plans. You know, how are they going to do, you know, really, right now they're saying, oh, you got to pay everything back on day, you know, the last day of the 6 month. But we both know that we, just like foreclosures are, you know, Val said, you know, foreclosures for 30 days, it's going to be, in, you know, not until next year. I think similar along the same lines, I think what they'll probably end up doing is just tacking it on to the end of the loan, because that's the easiest, most expeditious way. Everybody stays current, the bonds stay healthy. I mean, there's a lot of reasons why that would be done. But Fannie and Freddie at this point in time, you know, there's a lot. I think you may see something there if your or a loan is a government-backed security.
Yeah, I think it was 2 weeks ago, Fannie actually had a webinar they did through DS News or 5-Star talking about the 6-month forbearance period is forbearance period number 1, and then forbearance number 2 being another 6 months if they need to kind of collectively kicking the can down the road a little bit
Right.
to the new year to things. So let's talk about opportunities then. If you're a new note investor, if you were starting over in today's economy, where would you, with what you know, what would you focus on? Does that mean you'd avoid non-performing or vacant properties and focus more on performing notes, or those that are in modifications? What would you kind of focus? And we'll start first with you, Val.
I wouldn't stay away from non-performing. It really all depends on pricing. So you could look at the situation that we have now as how expensive your money is, how expensive your capital cost is, right? So for example, let's say take it back 6 months ago. If my capital cost was, let's say, 12%, then I wouldn't have purchased a note for 65% of value, right? But if my cost of capital was 6%, then maybe I would have done it. So it's really about how patient your money is. And I think Joe mentioned that earlier. So it really depends how patient your money is. I said before, yeah, we can probably wait a year to foreclose from now on, but maybe not. You know, I don't have the answer. It's an assumption based on what's going on and what I hear on TV. But yeah, you could buy non-performing notes. You could buy performing. As far as the buying criteria, it should be the same. But you have to take that calculation into your pricing model and then take it from there. I've always been a big supporter of, I mean, it's everybody makes decisions based on their personal feelings, based on their cost of capital. I always like to purchase non-performing notes, and because the price is a lot lower. But I believe that everyone should follow their instinct. And it really comes down, I mean, we can talk a lot about ways of buying and why you're buying this area or not. At the end of the day, it comes down to cost of capital. And that tells you what you can get involved with and how patient that money is.
Joe, what about yourself?
Well, I think Val's right. It's cost of capital, but it also, I think, is what's your tolerance. I don't think I think it would be a poor statement if you said, well, you don't buy non-performing or only don't buy performing. First of all, it's what you feel comfortable with, and it's what you can buy the assets in. So I think really, I think that there's a foundation. I think you probably, in a perfect world, you'd want to blend it, just because you have some cash flow coming in, and then your cash is going out in order to resolve the ones that are non-performing. But I've always been, and I've said this, over the years, I'm kind of agnostic. And what I mean by that is I'm agnostic as to a first, I'm agnostic as to a second, I'm agnostic as to performing or non-performing. It's each thing, it's about the deal. And each deal is, each asset is different because it's in a different location, it's a different UPB, it's a variety of different factors. So I think you have to look at each thing individually. As much as we all would like to get everything in a nice little box because that makes it nice and pretty and everything, it just doesn't work out that way. And so I think you have to find your comfort zone, understand what you're doing. I wouldn't say, oh, well, you should go out and you should buy a non-performing first, a performing first, a non-performing second, and and an REO. It's a lot of different things going on, and it's in your infancy of understanding of the business. I think that puts you in a precarious position. What you do want to do is say, okay, I would like to do X. I'd like to acquire whatever this is. And then once you do it, focus on it, learn it, become better at it, figure out how, and then once you've kind of walked through it, then at that point in time, you can then expand. But it's, don't try and drink from a fire hose, drink from the faucet, and you can control it that way. And then I think that you will become better in the long run.
I agree totally with that. Now, what are some of the biggest mistakes that you're seeing note investors make with either the deal flow, their due diligence, or approaching you to buy assets? Because you guys are both buying and selling assets. So, Val, what's probably the thing that stands out the most when you think of a new investor coming to you that just drives you bonkers if they do something incorrectly, or what is that?
Let me think. I think I said it before. It's the assumption. Look. We've all made that mistake at one point. We all calculate our profits. Is it worth it for me, right? And then it gets to a point that, after you purchase a few notes, of course you are in this business to make money, not to break even, correct? So let's start with that. But we're going back to buying your first deals. And the biggest mistake everybody made, and I'm sure that I've made it too, let's be honest, is calculating your profits, right? Like I mentioned, I need to make 30%. I don't think I'm going to be making 30%. Or they only look at one exit strategy. If I foreclose, I'm only going to make that type of money. And I always like to tell them, listen, look at the rental market. I gave them the Columbus, Ohio example first. Look at the rental market. Look at the liquidity. How liquid is the market? How fast can you sell it, right? So you need to look at different strategies, especially if it's a non-performing occupier. And I tell them, look at we mentioned how long they've been in the house and so on and so forth. But if I have to pinpoint one mistake, is people saying to themselves, I assume, I'm not making enough money on this, especially first couple of loans. And I have to repeat, and I'm sorry for saying this again, make sure you secure your capital. Make sure the BPO is secure. Make sure the title is there, no judgment, no liens, and then go ahead and purchase it. You're going to make money. If your BPO is correct and your title is good and clean, you're going to do okay. But do not calculate your profits ahead of time. If I can repeat that 10 times, I think I would love to do that. But if I have to pick a mistake, is that because, have people not looked at BPOs? I'm sure they have. We shouldn't even discuss that. That's a must. You have to check your BPO. You have to run a title report. We shouldn't have a discussion about that. But I would have to say, calculating profits beforehand.
Yeah, you mean you shouldn't hold out for that perfect note deal, the one perfect thing that everything is right on. Joel, what about you? Now you're doing collateral review for a lot of investors. You've started doing that and helping people identify collateral issues and loan files and things like that. What's kind of the thing that you're seeing?
I think to digress to Val's point, because I got Count Your Money. It brought to mind the song "The Gambler" by Kenny Rogers. Don't count your money at the table, and I think that's a very valid perspective. And I see, I think people are doing a better job in looking at their assets, but it's not so much about what there's lots of sources to figure out, oh, if I'm going to do this is the kind of due diligence that needs to be performed. But the piece I think that people miss is that they make assumptions and they stay there and they get kind of rigid in what that is, or you know, where this is going to take me, as opposed to, you know, thinking out of the box a little bit. And there are, and I know that's a cliche, but there are some really, you know, interesting people that I've met over the years who are really sharp, and their brain works a little bit differently. And I think part of doing due diligence is trying to train your brain to look at things a little bit differently. Just on the whole concept of a note, buying a note versus buying the house, some people don't, that concept is foreign and difficult for them to digest. Once you kind of get past that, then you can start to see that it's kind of like three-dimensional or abstract thinking when it comes to notes. And some really interesting people over the years, you know, one person said that he wanted to buy 1,000 loans and modify 1,000 homes, which is I agree with him. I agree with him, but that's not reality. And so, and my point is, if I'm going here, if I'm being myopic, I'm going down this road, and I don't have the intellectual ability to make a little bit of a veer to the left or make a right turn or whatever the case may be, you might put yourself into a corner where you're not seeing everything. And again, you know, a lot of it's about understanding what's going on. But when I do look at a lot of collateral reviews, the biggest mistake I think people make is they make assumptions. Don't make any assumptions. Dot your I's, cross your T's. If you're unsure, go check it again, even though it's going to take you an extra 5 or 10 minutes or whatever the case may be. Don't make assumptions.
Yeah, I can remember you and I having conversations with an investor who bought a note in Indianapolis and didn't check the taxes and found out $5,000 was owed in taxes, and just like, oh my God, it's not a deal. And you're like, well, just turn it into a rental. You'll make it back up in 4 or 5 years and then sell it off then with depreciation and the profits. Like you said, quick. You've got to stick in your lane, but you've also got to be very flexible on the strategies if something goes a little haywire. And we all know things go left or right all the time, right?
Every day. I mean, you know, like I said, that's why I got gray hair.
Speak for yourself, Joe.
You've been silver for a while, Val.
I got a lot of it. It's just, you know, it's just going a different direction these days.
Where, let's talk a little about the commercial note market. I know, Val, you were the king of commercial note sales in New York for a while. Joel, you've done some of that stuff as well, too, and same here. Do you see the commercial note market having some more opportunities than maybe a little bit different than the residential market because it is the commercial space? Val?
The quick answer is I don't know. I don't know, but I can elaborate a little bit. I would have to say that right now they're in the same boat, give or take. If one market I think is going to be able, it's not going to be able to recoup as easy, it's the office market, the office buildings, because what this COVID situation taught us all that we can work from home just as fine as going to the office, and we can have our traders work from home and not pay the $20,000 a month rent in New York City or the $10,000 a month. I mean, it really enforced it. I mean, we all had ideas. Everybody worked from home at one point or another in their life. But now, because we had to, and everybody had to stay home, we realized that what's the point of paying X amount of money in rent? You know, every business is different. But when we talk about the finance industry, financial industry, the real estate, and you don't need an office. So I would have to assume, it's an assumption, right? I would have to assume that it's going to be a problem with renting offices or selling office buildings. But like I said, it's just an assumption. The real estate market is a different market. The commercial market is totally different than residential, including pricing, including foreclosure situations. So I think it's two different, it's apples and oranges. But if you asked about valuation, if that was your question in regards to valuation, I think Joel mentioned it before, there's going to be a hit. There's going to be a hit, 10, 15%. But let me finish with saying, I don't know. Because if you asked me 6 months ago, if you ever said to me that this will happen, what's happening today, I would have said to see a psychiatrist. I mean, I'm going to be honest with you, right? So none of us have even read in books about what's happening today. This is completely out there. So I don't know.
That's okay. Joel?
Well, to Val's point, look, my crystal ball may be working or maybe not. You know, even a broken clock is right twice a day. So let me couch my answer on that. But I think I agree with Val on the commercial office space, even more so, especially in Manhattan. You know, with just the sheer how expensive it is to rent there. And now you had people who are close, and now all of a sudden you got to have them further out. Does that mean companies are going to end up taking double the real estate that they have? There's no way they can afford to do it, or the market has to correct for it. So I think really people learning to work from home, I think you're going to see a lot of people continue to do so. I was speaking with an investor yesterday, and he works for Ford out of Michigan. He's been working at home throughout this whole thing. I have another friend of mine whose wife, she works for Marcus Millichap, the insurance company, and they're up in the Adirondacks at a cabin that they own to get away from everything in the city. So I think people have learned that they can work from other locations. One of my best friends, I was his best man, he was mine. His daughter is engaged. One works for Google, the other one worked for, I forget, another tech company, both in San Francisco. They were told that they were going to work from home for the rest of the year. So they decided, you know what, we've always wanted to live in Portland. Let's go to Portland. And they're working remotely from there. So my point is people are being creative, and necessity is creating some really interesting opportunities. Look, none of what we do could be done without the technology advances. And so I think you're seeing a lot of changes. I think Resi is going to continue to be what Resi is, because that's a little bit easier for us to get a pulse on it. I think that there is certain commercial buildings. I think you're going to see more of them available. And I think, but to Val's point, the subset of office building, I think that's a real challenge. Frankly, those are such big numbers. I would, you know, unless you're a big fund, you don't want to play there. But I think there could be some commercial opportunities. I was speaking with an investor yesterday, and he's looking to purchase a shopping mall. It's north in New York City. He thinks he can get it for $5 million, and it's probably worth $8 million. But you know, he's been in the space for a long time. So do we know everything that's going to happen? No, because there's a lot of, you know, you got hornets, you got killer hornets, you got all these crazy, we had an earthquake the other day. I mean, all these things coming together. So you know, when I get up in the morning, I never know what's going to greet me. And I don't think we really have a good sense of what's going to be there. But you have, in order investing in a note, factor in your downside. And I think it'll give you more comfort at night. You won't feel like you're walking a tightrope.
Yeah, I mean, that's the thing is, I think you're right. The office space market, the hotel market, I think has been hit so hard as well too. Yeah, I wouldn't be surprised if we see more grow houses buy office space because they can get it cheaper. You know, for the green markets out there that we're seeing pop up across the country. Yeah.
Well, yeah, but
I'm sorry. Go ahead, Joe. Go ahead.
no, I was just saying on the in the cannabis side, it's all about licensure too, though. You can't just like go and there's a warehouse over in you know, in Santa Ana. Well, actually, Santa Ana is a bad example, but you know, in Beverly Hills, because you know, you have to be licensed and it's a whole different thing, but each state by state. But yeah, there are certain opportunities. Now, if you really want to kind of couple those things and you're interested, when you can look at specific states, California, Oklahoma, Nevada, just states in the West that where cannabis is legal. And if you were looking at real estate and maybe commercial real estate, so if you found something that would be in a specific area where you could have it, plus then it could be an opportunity zone. Now that could be a really interesting play.
Mm-hmm. Val, what were you going to say?
You have to, we're talking about commercial notes or commercial buildings, but keep in mind that an 8-family building is a commercial building, right? So anything 5 units and up is, residential commercial building, multi-families. Give you an example. I have a building. There's 11 residential units and 4 commercial. Every single one of the residential units tenants have sent me a letter saying that they cannot pay the rent. Now keep in mind that 6 of the 11 work for the city, the transit, firefighters, cops, and what have you. So they're working. They haven't been at home at all. The wives are nurses and what have you. So they're all working, except for 4. But they take advantage of the situation. It is what it is, and there's nothing you can do. Now, you have to calculate that in the liberal states, and I go back to politics, I'm sorry, but I have to say it. In liberal states, you're going to get hit with this. In conservative states, in the red states, you're going to have a chance to go to the court system. It's not going to be easy. But in the blue states, it's going to be almost impossible to do anything. One of my tenants is T-Mobile, the cell phone. They send me a letter that they cannot pay the rent. Just think about it for a second. It's a T-Mobile store. They sell cell phones. They cannot pay the freaking $3,500 a month rent. So my point here to conclude is that when you have people now that haven't paid the rent for the past 5 months, what is it, March, April, May, okay, 4 months now in June, it's gonna be tough to get them to start paying rent. Just like someone that hasn't paid the mortgage in 5 years, now you tell them, hey, your mortgage payment was $3,000, you can pay $1,500. That's $1,500 more than I paid, than zero. So we have to take everything. And I said, I'm a very optimistic guy. You guys know me a long time. And I always see the light at the end of every tunnel. In this situation that we are in now, I'm trying to learn the psychic of the human being, because that's really what it comes down to. Why do I have to pay the rent when it was okay for the last 4 months? I didn't have to pay it. So we'll all work together. We'll all learn together. This is something that hasn't happened in the history of this country. And but you have to look at liberal states and conservative states. It's going to be a big deal in your investment strategy.
Totally makes sense out there as well. And then there's opportunities. You just got to know where to look. There's, I think the smaller mom pop owners, operators are probably going to be hit heavier, obviously, than the bigger firms. But like you said, if T-Mobile's not paying their rent, I think we can thank Subway for coming out and saying we're not paying rent in any of our 20,000 locations. Do you go and then barter for sandwiches if you've got a Subway tenant? You can only eat so many turkey subs for a while, but figuring out other ways to make things work, reduce rent or staggering rent payments if need be, and then going from there. But you're right. It's you have to shake your head at like people are going to take advantage of the situation no matter what. I mean, we look at what's going on in Oregon and Seattle being such a difficult investment market before all this stuff happened too. We think some more of those things are going to happen across the country. You got to pay your tenants to kick them out or do other things. What do you think? No? Yeah, either one of you guys.
I don't have an answer for that.
Okay.
I really don't. Yeah, it's the whole thing is just complicated. Now we have riots. You have to take that into account. I'll let Joel answer this question. Go ahead, Joel.
I think we really
Toss the grenade in your lap there, Joel. Did you just see him do that?
I love you, Joel. Go ahead.
When you're an investor, you have to deal with things at a calm, level head. So I'll deal with Val's grenade on with a calm, level head. No, I think that there are going to be certain challenges out there. There's not even a question. And I think that you have to just adapt to what's taking place. You have to you don't have to understand. You just have to be a good listener. And and listen to what's taking place in the market. Look at what's in the news, and frankly, separating separating the data that's germane to you, as opposed to trying to take it all in, and you kind of maybe lose sight of what you're really trying to attain or achieve. So I think, kind of, you're going to have to adapt. We haven't seen the full impact of what's taken place over the next 90 days yet. We are not going to see it till the third quarter for sure, just because we don't know how all these the ins, the outs, the PPP loans, how all of that going to intersect. But I think the optimistic perspective is the fact that things haven't cratered anywhere near as fast. If you go back to, I think it was October of 2008, when everything hit the skids. I remember Secretary of the Treasury, Henry Paulson, coming on, and he put in a bunch of different things. It was right before an election, which I thought was very insightful and brave, and everybody, but there was a lot going on there, and we were cratering, and they had to do something. We're not in a similar position, so I don't think you have to be as coming forward as anywhere near as fast. I think there's some things that the government needs to prop it up, but I think I just don't see that big gigantic adjustment into the market, whether it's commercial, residential, or now these companies taking advantage of it. They're going to do what they're going to do, but eventually I would assume they're going to have to come correct, unless they're going to reduce their footprint.
The difference, guys, between 2008 and now, another difference. In 2008, there was only one solution that was able to solve the problem. That was money. That's it. You had money, the credit crunch, there was no more credit crunch, opened up. Money solved it. In this, what we are in now, it's not about money. I repeat, we have the greatest economy. This is man-made. This is something that this world has never seen. Again, I don't want to go back to the conspiracy theories and what have you, but this money doesn't solve this. Because we have people, look, much respect to the people that the people that lost loved ones to the coronavirus. I know people that passed away. Saying what I'm saying right now, and somebody has a mother or father that passed away, it sounds horrible. And we have my wife is a nurse in a hospital. She's dealt with that every day. Okay, having said that, let's look at reality. They just collapsed the entire world over something that kills less than 0.5%. We have to, I'm an immigrant, and I could tell you that these riots today are not helping the country. So at the end of the day, what solves now is we need psychologists for people to understand, hey, rioting and breaking down stores on Fifth Avenue doesn't bring people together. Doesn't bring black and whites and immigrants and non-immigrants together. We have to see every family should look within themselves and say, hey, what can we do to make this world better? Breaking windows is not going to help us. So I agree with you, Joel, and I agree with you, Scott. I just, I guess I wanted to say what I have to say. But in our situation now, money doesn't help. Paying people $1,000 a week to stay home when they were making $600 a week, it doesn't help them go back to work. So we're going to have a problem, and everything's going to be a psychological problem. Getting people back to work, to actually work to make money, and that's my feeling about it.
Yeah, I think we're going to see a whole new wave of PTSD, pandemic, traumatic stress disorders. Everybody being all stressed out about everything like that. Oh, I can't do anything. Can't leave the house. It's definitely a thing out there. Let's.
Can I finish on a positive note?
Yes, please do, Val.
To everyone that's listening and watching us, this will all pass. Whatever we feel, whatever I feel, I have a feeling. Joel and Scott, we all have different feelings and maybe the same. At the end of the day, everything will pass. This is nothing compared to our grandparents that lived in World War II or World War I, the 1920s, the 30s, the 40s. My grandparents didn't have food. They couldn't feed my parents, the children they had. So that was really a problem. What we're facing now is something new and hard for all of us because we haven't experienced the real bad times. So this will all pass. I think we're all gonna become stronger together. everything, the ride, everything that's going on, it's going to bring us, at the end of the day, it's going to bring us together, because that's the only way to move forward. But we also have to be honest and speak our minds. And by doing that, it brings everybody together and we'll move forward. Everything will pass. We're going to be okay. By your next conference, we'll be fine.
Exactly. Now, I have to ask a question. Does everybody in your family have a TV there in the room for everybody to watch something different? They're behind you. Got 3 big screen TVs behind you there, Val.
This is the media room.
Oh, okay.
Yeah, so I'm a big sports guy. I like to watch soccer and what have you. Yeah.
That's a good stuff there. Joel, what about yourself, man?
So,
Oh, I didn't ask a question. I mean, sorry. Let's switch this up a little bit. Here's a better idea. I was just thinking about it, and I thought I'd ask it, but I didn't. What steps would you be taking to prepare yourself for 6 to 12 months? What are some things that you would be recommending investors, seasoned or new ones, to start putting in place so they can take advantage if something does, if we do see a big opportunity? I think we're going to see opportunity regardless at some point. But what are the things that you would recommend that they start doing now to put that in a much better place than 60 days, 6 months, or 2021?
I think that there's going to be continual opportunity as far as product is concerned. The volume of product is obviously ebb and flow between, dictated what's taking place in the economy, different institutions' balance sheets, liquidations of different other funds, so it kind of trickles down. But what I would do is I'd be spending my time, learning, getting some education, getting some hands-on education. Learn about what's taking place. Put together your network of vendors. If you're going to be an investor into the space, find out what works, what doesn't work. Not everybody's going to be your cup of tea. I can tell you right now that, as charming as my wife might think I am, there was a lot of people before her that didn't think I was that charming. So, but eventually, once you find that sweet spot with your relationships in your vendors, I think creating that foundation and then also learning to network. The challenge that people in the note space today are going to have, and again, I think for at least the next year, there's not going to be any in-person conferences. There's just no will, want, or desire to have them. So you have to find other ways in which to create relationships. Sometimes it's about sending a LinkedIn note and saying, hey, whatever. Or if you see somebody or you think, hey, would you mind giving me an introduction to Val? Things of that nature. So I think you're going to have to be a little bit more creative in how you create your network and your vendor network.
Sorry, didn't want to interrupt you there. Thank you, Val. Buddy of mine posted something today, and I had to laugh about this, that the mayor of Houston announced today that he was increasing the amount of people that could get together for in-person meetings up to 12. Okay? Up to 12 people. But protests were allowed up to 100 people. So I think I'm going to do the next note event as a protest, so we can have more than 12 people at it in person. A protest event. How's that sound?
Don't get me started.
Well, I don't know. You're going to get a lot of divergent political perspectives on that, so maybe that might not be. But I get the sentiment.
So Val, what would you recommend people doing? Probably something similar. You've talked about education before. One thing, you've done a great job with your exchange of having different scenarios that people can run with the different exit strategies for a variety of things. Maybe talk a little bit about that, because I think that's such a huge, valuable tool that I don't think it's taken advantage of as much, especially for new people.
Right. And I wanna point to something that Joel said earlier. Things that you want to do in the meantime is learn to adapt. And I think that's probably one of the biggest nuggets that people need to take from this meeting. Learn to adapt. Learn, listen. Joel mentioned it 100% right. Try to listen and try to take everything in and to see how you can adapt to the new market. And if I have a weakness, I have to be, that is it, adaptation, adapting to the new thing, right? Maybe I'm slow to adapt, but once I do, I go 100 miles an hour, right? As you probably know me. But learning to adapt is a skill, and Joel, I got to thank you for mentioning that. That's probably something that we all have to learn because we have a lot of time now, right, to adapt. In regards to the exchange and the 5 exit strategy, I mentioned earlier that when you purchase a note, try to look at the different scenarios, the different exit strategies that you can incorporate with that note. Now, again, I repeat, you don't know what's going to happen until you make that first phone call. But once you make that first phone call, always keep the 5 or the 6, whatever many exit strategies. You can foreclose, you can reperform, you can do a deed in lieu, you can trade the note, you can actually sell the note to somebody else. So there are so many exit strategies. You always have to keep them in front of you. You know, that conversation, you can talk to someone for 10 minutes on the phone with a homeowner. In 20 seconds, you'll know we're going this route. So having those exit strategies in front of you are very important and will save you a lot of money. And because in our business, it's about cash on cash, the investment rate of return, right? How fast did you get out of the note? So again, I have to repeat what Joel said: education. Educate yourself as much as you can, because we'll never have this time again. I don't think this time being home and having the time to learn and what have you. And as I mentioned earlier, I like to repeat myself. If I think something is very important, learn to adapt, because we all need to learn to adapt, like Joe said, to the new market, to the new ways of doing business. And we all have to learn that it's a talent, right? It's important. I hope I answered your question.
Very much so, because you guys both we're still buying and selling assets. I know, Joel, you're looking at assets of mine. Joel, you sent me some assets to look at. Val, you've got stuff on the portfolio. I'm seeing the weekly featured deal on the platform, stuff like that. So there's a lot of things. So somebody who's brand new wanting to look at buy their first deal. Let's talk about, besides putting things in place, they're ready to pull the trigger now. They need to know the due diligence to secure their capital, pull title, pull values, look at that stuff there for you. Let's talk a little bit about maybe somebody being hesitant because they haven't raised capital yet for. Let's come to that and kind of make that kind of the last question here for everybody. A lot of people are afraid that, I got to have $500,000 or $250,000 to get started, and that's not the case. Can we agree to that? Yes. Thumb up for you both. So what would you recommend somebody who's reaching out to a trader, a new investor reaching out to the trader in communication or talking about what they're focused on? Do they disclose the fact that they're brand new and they're getting started? They've got some experience, don't have experience. Be truthful or be one of the guys, I got $20 million to buy notes with every month from. I mean, I think we know that's not truthful for most part, but where would you start with that? And we'll go first to Joel and we'll go to Val there.
Well, first of all, I think when I speak to somebody, no matter what I'm doing, I like to learn a little bit about them. And I think because that gives you insight into where kind of what they're thinking, someone might say something in the middle of conversation. So, you know what? I have this, I haven't really gone through it yet, but this might fit for you. So I think having an honest conversation is really important. Yes, you don't need $1 million to get started, depending on what your capital is, how your capital is aligned, whether it's yours, IRAs, family money or family and friends money, whatever the case may be. It doesn't have to be, you're not trying, you don't have to be a Rockefeller to get started. But I think to get started, you have to have an honest conversation. And, sometimes, again, you're going to find things, oh, gee, I never thought of that. Oh, I spoke with Val today, or I spoke with Joel today. And, and all of a sudden the light bulb goes off, and it might trigger something that it's going to make you better in what you're pursuing and how you're going to do it. But for instance, someone picks up the phone to call me. I want to learn a little, where do you live? What do you do? What's your background? Frankly, what do you like? I'm a giant baseball fan. Sorry for right now, but I collect vinyl records. So, but sometimes that opens up a dialogue, and then you create relationships, and you learn. And someone might say to you, because it's happened to me numerous times, is, you know what? You need to speak with so-and-so. Let me send them a text. So I think being honest, having a good conversation, and if you don't understand it, okay, you know, it's okay to raise your hand. Certain people will not want to have that dialogue with you, but frankly, you don't want to have the dialogue with them either. You know, that knife cuts both ways. You should never feel someone's big timing you, I guess. And if they do, it's probably not something that's going to be beneficial for you professionally or intellectually. So that I would try and have honest conversations, say what you're trying to do. And because they might come back to you and say, you know what, have you ever thought of this? And then all of a sudden there's an evolution of thought. And I think that's really the important piece. Everything else, there are certain, when I would speak to groups and I would stand up, and one of the first questions I would ask is, how many people are engineers? And you would get 40 to 60% of people were engineers, because engineers have a very, the way they think, and it's about, you know, sharp corners. It's not about rounded edges. Numbers are numbers. They tell you, the data will tell you stuff, and I think that's important. So a lot of times people with engineering background or some mathematical or science background really have a really good understanding of what takes place in the node space. Again, to Val's point, it's about learning who you're with, who you're talking to, how you can best help them, and frankly, creating a give and take of a relationship. And I think that will benefit you at the same as an investor. Long-winded answer.
Nope, great answer though. Val?
Honesty is the best policy, right? So look, we've been around a long time as traders, that we know the lingo, you know, of this business. So I used to tell my traders, if anybody calls the trade desk and says that they have $15 million to trade, just hang up the phone. Or politely tell them, you know, listen, go to somebody else. Because the truth is, people that have $15 million, they don't need to come to Watermark. They can go to the bank that Watermark buys from, right? At the same time, be honest with us, because if you tell me I just started in the business, we can send you to cop cars. We can send you to someone to learn the business, because it makes my job easier. I'm not an educator, I'm a trader, right? So, you know, I have a lot of people try to play like they've been around a while. I have cousins that are electricians, and I've learned a lot about the electrician business. And I can probably talk to you, Scott, and you'll say, Val knows a lot. But when I speak to an electrician, they can pick me up in 20 seconds. You hear conversations about it, you know, you try to pass yourself as an electrician. Same as in our business, in every business. You can pick up someone in 20 seconds that they've never purchased notes before, which is fine. We sell to people that can buy 50 notes and people that buy 1 note. Be honest, because if you're honest, the money is in your pocket. If you're honest with the trader will give you the time of day. But if you make believe that you're a big trader, that you've done big trades, you can get tripped up in one question. If we ask a question, you get tripped up, and then you know what happens? That red flag goes up. And then the relation didn't start the right way. So do the right thing. And everybody knows that I like to stay on the phone with people and help them out and give them free information. I don't care if they buy from us or not. I like to help. But just be honest. Just say, hey, I just started in the business. Okay, I'm not going to buy today. I got a couple of questions about this and that. And a lot of people will give you that 5 minutes if you're nice and honest about it. And that's my answer on that. That's it.
Where is and the last question, we'll wrap this up here. Once this clears up, where are you looking forward to going to? Where are you looking forward to getting out of Dodge, staying home, hitting on a trip, getting overseas? Where's the place that you'd like to go? Joel, I'm sure you're just going to go to Disneyland down the road from your house, right? No.
Well, they got to open it back up, but unfortunately, you know, as you know, my son got an internship, and that went sideways with the whole thing. But if I was going there, I'd probably go to Sedona. I love Sedona. We have a timeshare there. It's peaceful. It's a way, kind of like turning it off and kind of putting your phone away. And the majestic beauty of it all. So if there's a go-to place for me, it's Sedona.
So, Val?
I don't know. I got used to staying home. I may just stay home. But we used to take things for granted before, right? Going to a restaurant with the wife and the kids, and going to a cafe and just have a coffee, sit down. We used to take this for granted, right? And now we can't wait for that cafe down the block to open up so we can go and sit down and enjoy a cup of coffee. But at the end of the day, what's important is that we are all healthy. Everyone is healthy, and like I said, this will pass, and we're gonna be okay. And we'll tell our grandkids, this will be a conversation. Hey, we were stuck in the house for 4 months one time, But my end message is let's make the best of this. And yeah, when they let us go out to a restaurant, I guess everyone will go to a place and help the local businesses. That's really what it comes down to.
Yeah, definitely. Well, guys, I want to thank you both for coming on Note Camp here. Always good to see you both. Wish was there in person, obviously, but glad to see you both. And thanks for coming. I know that everybody appreciated the conversation and the panel. Don't be surprised to get a few people that reach out to you as well. And is it okay? I'll share your information with those that attended so that they can reach out to you as well for you in your services, and reach out to the website as well too for you. But give my best to both your lovely wives and the kids, and Steph sends her love as well to both of y'all.
Thank you, Scott. Thank you.
Thank you. Appreciate it. All right, guys, don't go anywhere. We're just going to take a quick 1 minute to stop the recording of the session.